I'm Charlotte McLeod with the Investing News Network, and here today with me is Keith Weiner, founder and CEO of Monetary Metals. Thank you so much for joining me online today. It's great to see you again.
Thanks for having me, Charlotte.
Really good to be speaking with you. And we're here because you just published a report on how not to think about gold. It's a really interesting report, and we're going to go through a lot of the stuff that's in there. What I want to begin with, though, is kind of flip the topic on its head and discuss how we should think about gold, which is something that you go into at the end of that report. So one of the things that you bring up is the US dollar and the problems that you see there. And this is a key reason why people should think about owning gold. But I was interested to see that you don't talk about a collapse in the dollar. And I wanted to begin there because we are hearing these more extreme headlines right now about the dollar. So if we could just start there and hear from you about what's actually going on with the dollar right now and perhaps how that relates to gold.
So a lot of things going on, but as far as collapse, somebody posted to Twitter, and I'm trying to remember who, a couple of weeks back, and it was a collection of, I think, Time headlines about the coming, death of the dollar, going back to, I think, the 1950s or 1960s. So it's a perennial favorite topic that people love to predict. And, it's the old joke about, successfully predicted 17 of the past 0 hyperinflations, kind of thing. Every time there's, something ugly going on, geopolitically or otherwise, a war, think back to the 1960s, Vietnam, and everybody just goes to their favorite, horse to whip, I guess, it's the dollar. But I think people should really look at it as there's one currency world, and that is a dollar world. And, if you thought of all the other, currencies, first of all, it's dollar derivatives. That is, that they derive from the dollar, they're backed by dollars. And in a certain sense, they're almost like, in the late 19th century, the Western Virginia coal mining company town that would issue their scrip, their paper scrip. And then imagine if somebody saw that somebody from one company coal mining town doing business and trading with somebody from a different company coal mining town, and somehow they accepted the scrip of the opposing town, and then the headline in the local paper about how the scrip is replacing the dollar. You kind of have to shake your head and say, that's pretty provincial. That is not going to happen. The world depends on dollars. Everybody has dollar debts, which means they're desperate for dollar revenues. And when everybody's choosing what currency to hold, it's one thing to say, okay, so-and-so country bought, let's say, oil from another country, and they paid in, remitted in whatever, currency that might be. But what currency do they choose to hold until the millisecond before the transaction? It's not that other country's currency. Nobody wants to be a creditor to Putin, for example. Nobody's choosing to. So to hold the currency, you're lending, you're becoming a creditor to that country. Nobody's choosing to be a creditor to Putin or Xi or Modi or Lula, right? And then so they remit in that currency. And then what does the other side do? Right after they receive whatever currency, they may turn around and swap it for dollars anyway, because people's preference for what they choose to hold isn't necessarily the headline of what the transaction was done in. And so there is no paper currency that can replace the dollar. There's one thing that can replace the dollar, but ain't nobody want that. So it's a shiny yellow metal with a 4-letter word. Ain't nobody want that. And meanwhile, in terms of other paper currencies, forget about it, as they say in New York.
Okay, so for you, when it comes to rumors about the dollar's death, those are exaggerated, but you do see a decline in the dollar coming in some way, and this is why we should think about owning gold. So I wondered if you could talk a little bit about that, the future of the dollar as you see it, because I think that's really important for people to understand here.
I think I would emphasize, I see a decline of the entire dollar regime and all of its derivatives. So if you think of the dollar as the Titanic, all the other currencies are various bits and pieces of the ship. They're not succeeding against the dollar. The whole thing is failing, in more objective terms. And the reason is, right, so people think of it as a quantity thing, right? I mean, the Fed, the dollar's official manager or central planner increase the quantity of dollars that are out there. That's certainly true. And then they tend to get caught up in counting, dollars. And there's all these different debates as to what's the right measure of the money supply. Is it M0? Is it M3? Is it some other Austrian money supply or true money supply or whatever? But the real root of it is they cheat. In fact, that's not a bug, it's a feature. That's the intention of the system. Gold, yes, it's true, has a finite quantity and is not very easily increased, except at great risk and cost and all the rest of that. Gold mining is not an easy business, and gold exploration definitely doubly so. But the thing with gold is you can't really cheat. You start cheating and you lose all your depositors. And so, that was amply well understood by the time they created the Fed and the other central banks. And the whole point is to cheat. Every time something comes along, they just say, well, let's just, change the rules. Let's just tinker. So late 2000 or early 2009, people said, even if it may or may not have been the cause of the crisis, it's certainly exacerbating the crisis, that banks have to mark their losses to market on their balance sheet. Let's change the accounting rules, and the banks no longer have to, if a bank had bought something at $1 and it's now worth 10 cents, they can still keep it as $1 on their books for statutory purposes and reporting purposes. When they changed that rule, the Financial Accounting Standard Board changed that rule, I want to say it was March or April of 2009. That was like to the day that the stock market hit its final bottom and then began a new bull market. And on the heels of not any kind of improvement in the economy, but in the change in accounting treatment to move from greater honesty to lesser honesty. There's a decrease in honesty of reporting. Ironically, we have a banking crisis today, and the Silicon or incipient crisis, I guess. It's not a full-blown crisis yet. Silicon Valley Bank was saying that all these bonds are hold to maturity, therefore we can keep them at $1, even though they've lost 20 or 25%. And then they get an outflow of deposits. They have to start selling them. That's when they realize the losses. That's when people start to realize that they're realizing losses, saying, wait a minute, this bank is insolvent. Yeah, and so all, you can declare that you never intend to sell, but you have no means to make good on that promise ultimately. So the managers of the system keep on cheating. And so Silicon Valley Bank fails. And at first they said, okay, anybody with less than the statutory $250,000 deposit, which is FDIC insured, their funds will be available on Monday. Everyone else is going to get whatever it is, 40 cents on the dollar until we figure out what happens to liquidation, which will take months or years. Then by Sunday, they said, oh, by the way, another bank failed, Signature Bank. And everybody's deposits, even over $250,000, are going to be covered. And so the law just goes, out the window. And, can you really count on it? I don't think you can count on that. They didn't change the law. They just said we're suspending it because Silicon Valley Bank is systemically important. All of a sudden, they declared that. And so with each thing that they do, it has to make creditors pause and just think, do I want to be a creditor to this? And if you don't want to be a creditor to it, gold is the thing you buy, gold being money. That's kind of my unique view, and even other Austrian economists will argue with me about that. It's a definitional thing, right? When money is generally accepted medium of exchange, I say, well, gold being money, and one thing you can understand clearly if you realize that money is the thing you hold if you don't choose to invest it in anything else. So if you don't want to buy properties, you don't want to buy shares, you don't even want to be a creditor to a bank, what's the one thing you hold? Well, you hold the gold coin in your hand. And so we see that today, of course. The gold price is absolutely robust, near all-time highs in US dollars, making new all-time highs in certain other currencies. And it's unloved, not talked about. It was the opposite of Tesla or any of the other meme stocks at their peaks. Yet it's really high. It's because people are saying, well, I don't want to hold the bank deposit. I'd rather hold gold, because yes, there's price risk with gold, but there isn't risk that my gold could go away if the bank turns out to be less solvent than I thought.
Right. And I think a related point that you mentioned in the report and that I wanted to highlight was you mentioned, if we are in a scenario where there's a collapse in the dollar, you're not going to come out of that in a profit, right? That's not going to be good for people. And this is, again, another reason that people might want to look at gold. So I wondered if you could go over what you mean there, because I think that that might be something that people forget or don't think about all the time.
Yeah, I think it's easier to say, okay, what if gold goes to $20,000? So you buy it today at 2,000 ish, goes to 20,000 ish, you have a 10x gain. And with that idea of gain comes the idea that I profited, I increased in my wealth in some way. But if you realize that gold is money, then that makes the dollar something else. It's an irredeemable credit issued by a profligate borrower with neither means nor intent to repay. Big mouthful, but I'll stand by every word of that. And you realize it's the dollar going down and not gold going up. And you start to say, well, wait a minute, did gold go up? It went from 2,000 to 20,000. It went up in terms of what? In terms of something that we just said is falling. So imagine, I like to try to create a visual for people to picture this. And I have two that I'll use. One is, imagine you take a brick, you're standing at the top of a cliff. You take a brick and you strap a GoPro camera to it. And you throw the brick over the edge of the cliff. And right after that, you throw a piece of plywood. Now, both of them are going to fall. The brick will fall faster because it has a greater mass to surface area ratio. Therefore, it will overcome wind friction and hit higher terminal velocity. From the perspective of the camera, which is attached to the brick, the wood appears to be going up. And so you just have the wrong vantage point, or for that matter, the top of the cliff, which isn't going anywhere, appears to be going up. And so that's the distortion of using the dollar, try to measure something like that. The other analogy I like to use is, imagine you're on the deck of a ship, which is both sinking slowly, because there's a leak in the side, and there's a big storm and there's waves going up and down. And so imagine you're standing there with somebody, you're saying to this other person, and you're looking at a lighthouse on shore, saying, why is the lighthouse going up and down and mostly up? Well, is it? And then imagine cheering the idea that the lighthouse is going to go up, 50 feet relative to where the lighthouse is now. Well, is that really a good thing? If the lighthouse goes up 50 feet, then that would mean you're under water. Probably, depending how big the ship is. Right? That's not a good thing. As South Africa is demonstrating right now, even if you're a lucky or foresighted person who has solar panels and a generator set, if the entire rest of the country has no electricity and therefore food and water and other things, you're not really safe from those people, and your food supply isn't safe. So nobody should wish the prevailing currency and therefore everyone else's savings and capital, including their ability to produce food and energy, to crash like that. That's a calamity that, unless you want to see all of society burn, you shouldn't wish for that.
Yeah, I think that's very key to remember. And so you're really encouraging people to reframe how they think about gold, which is very interesting. What I want to move into now is talking about some of the points that you made on how we shouldn't be thinking about gold. And there are, I think you make about 8 different points. We'll try to go through some of them, and some of them we may already have touched on. We'll link to the report in the video description so that people can read the full thing if you want. But the first one that I wanted to pull out, because it's kind of related to current events, we had the rate hike from the Fed this past week, is gold and interest rates. So typically we hear if rates go up, gold should go down, and vice versa. And I wanted to get your thoughts on that, because even looking at what we saw this past week, I think that people can maybe see that this isn't really exactly how it works.
No, and all you have to do is zoom out, let's say to the beginning when the price of gold was completely divorced from the dollar in 1971. And then look at interest rates and look at the price of gold and plot the two together. There just isn't really a great correlation between the two. Shorter term, you may get some correlation, you get some self-fulfilling prophecy, right? If all the traders think that's what it should be, and the interest rate goes up, they buy gold a little bit. I think actually, if you really study it, what you're going to see is that the price of gold, correlates to a spread between marginal time preference and the market rate of interest. So when the interest rate is being pushed below people's time preference, then people are turning to gold. But time preference can move all over the place, and there's no data series. The Fed doesn't publish time preference as a series. publishes all the interest rates and money stocks and CPIs and all sorts of, aggregate data. But time preference isn't one of those things. But, you think about it, if the banks are offering you interest that you like, you're happy with, you have very little reason to buy gold, and there's an opportunity cost. If the banks are offering you interest that for whatever reason you regard to be crap, either because they're zero, or in the 1970s, it could be 12% in the bank. But if you feel that the money is losing its value at 18%, you're not happy with 12, so time preference is going up. And therefore the interest rate would have to go up to satisfy you. And if it doesn't, then people turn to gold. So you'll see a rising gold price during times of rising interest rates, and you'll see a rising gold price in terms of in periods of falling interest rates, and vice versa. So it's one of those things that sort of intuitively seems to make sense, but on deeper theoretical grounds it doesn't, and the data does not bear it out.
Right. So it's a little bit trickier than people think. And relatedly, so we have the Fed hiking rates in order to fight inflation. And when it comes to gold and inflation, you might hear that gold goes higher when inflation goes higher. You might hear that gold is a hedge against inflation. And you made some interesting points on those topics as well, which I'm wondering if you can highlight here.
So the problem with the word inflation is encompasses two, and people, inflation meaning rising prices. Yes, I'm aware of the monetarist argument. Inflation is to do with the money supply, not consumer prices, which is deemed to be the direct, almost linear consequence of the quantity of dollars increasing. But if what we're saying is that when prices go up, we call that inflation, which is what most people say, there are multiple different causes, multiple different forces that can push prices up. And I'll use an example. Here in Arizona, we switched, I guess about a month ago, from the winter blend of gasoline to the summer blend of gasoline. And with that comes a big jump in the price. It has nothing to do with demand and everything to do with regulators force the petroleum companies to put, I don't know what chemical, it used to be MBTE. I've been told now that that's no longer environmentally friendly or whatever. So there's something else with their alcohol. It used to be alcohol before that. They forced them to put something in the gas, which is expensive to add, and which people don't really appreciate, don't value, and often don't even know it's there. So if the price of gas goes up 20%, and gas is one of the components of the consumer price index, then you'd say, oh, look, CPI is rising. And then you look at gold and say, well, gold isn't rising. Yeah, why would gold respond to a regulator saying that you're forced to put an expensive chemical in the gasoline? It wouldn't. And so sometimes in my more perverse, moment when people talk about the purchasing power of a currency and that measures, debasement, I say, okay, well, let's talk about the purchasing power of the dollar, but let's be precise. Do you mean the Midtown Manhattan dollar, or do you mean the Yuma, Arizona dollar? Because the Yuma, Arizona dollar will buy like 10 times as much as the Midtown Manhattan dollar. Of course, it's the same dollar, but costs are very different in Yuma for non-monetary reasons. Right? There's a lot of unemployment there. Labor is a lot cheaper. There's a lot less regulation. You want to open a restaurant, there's food inspectors, but they're not as aggressive as New York, and there aren't all the crazy environmental and green energy restrictions and whatever in Yuma that there are in New York. And so gold is going to be tracking the monetary phenomena as the dollar is losing value, but not tracking all the other random stuff that happens to push consumer prices up that aren't monetary but are lumped into that package deal that we call inflation.
Yeah, okay. I'm going to take just a small pause here because, again, we're talking about different ways of thinking about things that investors might not be used to. We're used to looking at the Fed, interest rates, inflation, and thinking about how they impact gold in a certain way. And so for you, if people are trying to adjust how they look at this, should they still be considering these factors and just looking at them in a different way? What would your advice be for people here?
I mean, I think it's tempting to say that in a broad sense, inflation consumer price index is measuring the falling value of the dollar. But be very careful of sort of two fallacies. One, that you're lumping multiple quite different causes in, and some of those causes aren't going to have any impact on gold. And then two, the problem of any macroeconomic aggregate, remember, the first economics lecture that I was in, I didn't take a conventional course of economics. I have a PhD, quote unquote, but it's, not a credentialed degree. I can never get a job with that, PhD behind my name. But, one of the discussions was this idea of aggregate. So imagine you have two people and there's two steak dinners and you think everything's happy. And then zoom out a little bit and you see that one of them is a really fat guy sitting there eating two steaks. And one of them is a skinny guy looking through the window hungry. And that's the problem with aggregate statistics, is they're inherently low resolution in what they really show. And if you're trying to understand gold or dollar debasement or any of these things by looking at that one low resolution, snapshot. Another analogy I like to use, and for those of you who have not visited the Grand Canyon here in Arizona, everybody should visit it. It is definitely one of the wonders of the world. It's an awe-inspiring place in every regard. Imagine if you hike to the bottom and you take out an older phone, so it's kind of low resolution, and you take a picture, which does not do it justice, by the way, it can't. And then, I don't know, when you get out of the canyon, you print that picture out and you send it to a fax machine, and someone has a fax of a picture taken at the bottom of the Grand Canyon. It just doesn't really communicate. Something's lost in the translation. And, that's part of what's going on and what I'm trying to say. I'm trying to say, think of things in a different way, because all the standard tropes, they're tempting, they're convenient. There are a lot of reasons that deeper and deeper you drill into the sort of Keynesian monetary system we have and all of the excuses that it manufactures for politicians to cheat, which is, again, a feature, not a bug. And everything is self-reinforcing. Everything's pointing back to, prices are going up, blame the Fed. And then politicians and regulators can get away with murder, literally, because, people are angry at the Fed. And then when you look at the Fed, well, then there's two factions, and one is saying, yes, you have to have inflation because it has to promote the jobs. And the other side saying, well, we promoted too much jobs and now inflation is running too high. And you realize it's this long-running, intractable debate over very abstract ideas. And both sides are writing equations on the board, talking about frameworks and models, and everything becomes hopelessly confused. And then you shrug your shoulders and you're like, okay, well, there's nothing to be done. Instead of saying, wait a minute, those danged regulators forced the gasoline company to add 30 cents a gallon of cost to my gas for no good reason. How about let's repeal that stupid regulation and the price of gas would come back to 30 cents to where it was in March. And so it's a lot of excuse making. It's a lot of sleight of hand, in a way. Almost the CPI measure of inflation is almost the greatest sleight of hand ever, because it diverts all the attention away from all these wrongful things going on to just look at this number and think it's the Fed, and the Fed is almost a ideal lightning rod to draw all that, rightful anger from what, what's happened. If you live in New England, they have been very successful at blocking both electric power coming in from Canada and Niagara Falls, and gas coming in via pipelines that they've blocked. And then the Jones Act blocks oil and natural gas from being shipped from Texas to New England. And so the cost of heating a house in the winter in New England is, substantially higher than it should be. And then, to think, oh, everybody blames the Fed for that and shrugs because nothing's to be done about it. They've in a way, they've not diffused, but maybe diluted the outrage about that, and just diffused. Spread it around to the point where everybody kind of feels there's nothing to be done about it. And there are things to be done. Unblock the pipelines, unblock the electric transmission lines, get rid of NIMBYism, and get energy to New England, which is what they need.
Yeah, you're right, though. You can get lost in that very quickly. So thank you for going into some of the things maybe people can pay attention to when they're looking at these topics. The other thing from your report that I wanted to pull out is technical analysis. So I can tell you that some of the most popular guests that we have here talking on our channel are technical analysts. And I think that this appeals to people because they always hear about, you can cut out all of the noise from things that we've been talking about right now. You can just look at the charts and they will be your source of truth. But you did raise some points to maybe caution people about technical analysis that I'm hoping you could talk about here.
Yeah, part of me wants to make a witty little quip about, you see the future line and the trend line in my palm, and I have some tarot cards, here as well. I if they're your most popular guest, I'm going to not make myself very popular by criticizing it, but I don't see how technical analysis can really be predictive, especially trend changes. I get that they can be a self-fulfilling prophecy during, there's a little, the market gets itself into a certain pattern or a certain mode, everyone's trading that chart, and then, then it changes. I don't see, if you look at all the top billionaires in the world and how they made their billions, anybody, doing chart analysis, getting to that point. And I also think, and I'll put this out as an economic theory, that some assets, technical analysis would work better than others, because the technical analysis, has the self-fulfilling prophecy implication to it. So if you take something like Bitcoin, I would have to assume that essentially 100% of all Bitcoiners are watching charts. But you take something like gold, it would be the opposite extreme. Most of the people in the world who have gold just aren't even paying attention to that chart. In every boardroom, at every private bank, and every wealth management group in Switzerland, there's somebody sitting down and planning an intergenerational trust to plan for the wealth of their grandkids and great grandkids. Gold is involved in every one of those, and chart as a consideration is not. And then they buy the gold, they put it in the trust, that's locked away, it's sitting in a vault under Geneva, a building in Geneva somewhere, or Zurich, for decades or a century or something like that. And I don't see charts just really having a lot of tangible reality relative to that. But I think this is one of those things where it's tempting, it's convenient, it's a mug's game. A lot of people get sucked into it, and of course there are plenty of people who make money teaching technical trading skills and give them tools and platforms and all that. Where are the, as the book says, where are the clients' yachts? Where are the people that are getting super rich trading this stuff? And I think the people who try to trade, any all the commodities and even shares to some degree, they're trying to trade it like with this frenzy of back and forth day trading. I don't think most of them end up getting what they wanted in the end.
Well, and speaking of unpopular opinions, I know because we've talked about this in the past, you also have what's probably an unpopular opinion on manipulation in the gold market, which also comes up in the report. So I know we could have probably an entire conversation around that, but I want to bring that up as well and just get briefly your thoughts on why you don't really follow that narrative. You don't believe in that.
There's a couple of things. So probably I wrote a lot of articles. I haven't written about it in quite a while. I wrote a lot of articles historically, and I think probably the best of them. So I think arguably the leading voice in the manipulation, especially on the silver side, was Ted Butler. And Ted Butler wrote this piece and he said, look, I'm an old man now. I'm retiring from all this. I've done my work. I've made my contribution to society. And I'm like a professor emeritus saying, okay, my body of knowledge is going to be inherited by others and to do with as they will. But in that spirit, if anyone has thoughtful disagreement, I encourage them to write. So I wrote a piece called Thoughtful Disagreement with Ted Butler, in which I started by saying whenever two scientific theories compete and disagree to explain something, what scientists do is they look for a corner case where the two theories predict opposite outcomes. So imagine Einstein predicts that when you find a super duper magnetic pulsing quasar thingy, that light is going to bend to the left. And suppose Lorentz has a theory that says it's going to bend to the right. All of physics, all of astrophysics is sitting on the edge of their chairs waiting for somebody to build a telescope big enough to find one of these objects. And then when they do, they're chewing their fingernails down. Well, was it left or right? Left or right? And it's left. Einstein has vindicated, Lorentz is in the ash bin of history, and the conflict is resolved. So I said, okay, the conspiracy theory says that those that are short futures are naked short and they're doing it to manipulate. My theory says that they're arbitrageurs pocketing a few pennies of spread, buying spot and selling future, and they're hedged. And let's find a corner case where they're going to predict opposite outcomes, and let's get the data to show that corner case. Monetary Metals, my company, has a subscription to see very high resolution data going back to 1996. So we can see every futures contract, 130 some odd, I think, during the period of that study in that paper, and how they behaved. And I'm not going to give away what the corner case was or whatever, but we have high resolution data to show that it behaved exactly as my arbitrage theory predicted and not at all as the manipulation theory predicts. That said, my experience in talking with central bankers, and I've met many of them around the world, not at the level of Yellen or Powell, the head of the bank, but 1 to 2 levels down. I've had plenty of conversations at cocktail parties and whatnot. And they don't think about gold. I really have to say that. If you ask them about gold, you get this pause and this slight frown. It would be, I've never done this, but I can imagine going up to a senior engineer at Tesla and asking about, well, what did you think of putting a carburetor in the Tesla? You'd get this pause and you'd be like, wait, what? Didn't that go out with bell-bottom jeans and, in the early 1970s? Like, that's been dead for 50 years, right? They don't think about it. On our podcast, we had Daniel DiMartino Booth, who worked at the Fed for, I think, 9 years, wrote a book called Fed Up. And she said the same thing. She said in all of her years, no one ever asked for a study on gold. It never came up in the minutes of a meeting. It wasn't asked about, it wasn't talked about. She said she spoke to Joseph Wang, who worked at the New York Fed. Same experience. None of the senior people were asking for any research on gold or anything else. They don't think about it. So the idea that they're secretly, conspiring in a dark cabal to manipulate it, it's like, why would they care? In their own stated, terms and given their own objectives, why would they care? They don't. And well, if the price goes up, it's a threat to them, but it isn't. Gold could be, they were saying this when gold was 200. Now it's 2,000, 10x higher. It's no more of a threat now than it was then. And it could be 20,000. It's not a threat. That's not how the system. The same thing that the euro is not a threat. The yuan is not a threat. Neither is gold. Not in that sense. Now, gold can be a threat in a different sense, but not because its price would be rising, but because it's remobilized for finance. That's a whole different proposition. But in terms of price going up, nobody cares. Let it go.
Right. And so what do you make then of all these headlines that we've been seeing for the last 6 months or so about the high levels of central bank gold buying we're seeing? Because that seems to say that, yeah, they do want to hold it, but I guess you're saying more that they don't care where the price is. Is that kind of what you're saying?
Well, it's the peripheral banks that are buying it. But the allegation of manipulation is, the Fed and the main central banks that are managing the system. I remember having a Twitter argument with a very prominent person who I won't name here, who said that China is simultaneously buying gold and shorting it to push the price down. So I jumped in. I said, okay, I'll buy it. I totally get, that in theory, somebody who had a huge amount of money that didn't care about losing could short something to try to push the price down. I totally get that China is interested in gold and they want to buy it up. But how do you do both at the same time? And he said, well, they're selling futures and buying metal. I said, okay, well, that's the thing that I study, this gold basis. There are charts for free, by the way, on monetary-metals.com. We publish that daily. We subscribe to all the data feeds and publish this. If you were shorting futures and buying metal, then the price of metal would be going up and the price of futures would be going down. And there's a spread between the two, which is called the gold basis. That spread would invert the way the Treasury yield curve is inverted. And you'd see that. And I said, I'd be on the rooftops bellowing that that's called backwardation. There'd be a massive gold backwardation if that happened. It hasn't happened. It's not happening. And, that's absurd. I think a lot of the central banks buy gold because they think the price is going to go up and they want an asset that's going to go up. And they're traders in that sense, not acting as managers of anything. They're just trying to maximize their value. And I think certainly in the last 6 months, with Russia being locked out of the SWIFT system, they're looking for other conveyance vehicles, right? It's still a dollar world. The economic calculation of what is a barrel of oil worth is a dollar calculation. But, if you're Russia, you can't exactly do business in dollars because the US and its allies, whatever you may think of, I'm not trying to get into offering my opinion on the rightfulness or the wrongfulness of anything regarding Ukraine, but just from their perspective, they're trying to sell oil and they're locked out of SWIFT. So gold becomes one of the things they turn to. One of my articles, I gave it a whimsical sort of title, something like "Gold, the Ruble, and Oil Walk into a Bar," ... or something. I don't know what the exact title of the article was, but I was talking about all this stuff. And I gave a thought experiment, and I said, suppose you're in your house and you're just busy and you're letting the front lawn is getting long and kind of weedy, and you're getting letters from the town saying we're going to start giving you fines if you don't mow your grass. And just then a kid rings the front doorbell and he says, "I'll mow your grass." And you say, "How much do you want?" And he says, "I want you to pay me 1 box of 8 ice cream sandwiches." And so you think about it, it's okay, that's about $8. That's about half an hour's worth of work. Okay, that seems a reasonable wage for an enterprising 14-year-old kid with a lawnmower. Sure, I'll do it. Is the ice cream sandwich really replacing the dollar? Is there anything about ice cream sandwiches? You look at the kid, you realize he's a bit chubby. He's asking for a reasonable price, and he wants you to do him the service of going to the store and buy the ice cream sandwiches. You look at his chubbiness and you say, okay, I get what's going on here. Dad and mom are saying, we want you to lose weight, and we're not going to let you buy ice cream sandwiches, even with money you earned, because it's not good for you. So he's doing an end run. He's kind of cheating on his parents, getting you to do the dirty chore for him. But it's not really changing anything. It's still fundamentally a dollar transaction. And are there peripheral central banks that are buying gold? Yes. There's always a simplification, and I call this the famous buyer's fallacy. The Central Bank of Ireland, announced they bought 7 tons of gold 1 month or whatever it is. And there's this implication that the people running that bank know more than the rest of us about what's coming next. And when you talk to these folks, as I have spoken to some of them, you find that they're not any different from, they're academic economists with PhDs and all this crap. So in that sense, maybe they know a bit more, but they're like any other academic PhD steeped in Keynesianism. They know an awful lot about very little or nothing. And, they have their opinions, most of which are informed by Keynes and Friedman, which is all rubbish. And they don't really know what's coming any more than anybody else. And the fact that they bought, which is true, it's also true that 100,000 people sold that 7 tons or whatever it is. Are the 100,000 people all wrong? And they're right because they're famous, and the 100,000 people who sold aren't famous. Maybe sometimes they're right, and maybe sometimes they're not. And all this stuff. If you're trying to trade gold based on all these signals, you're just going to be frustrated. And at the end of the day, which is kind of the point of the report.
Right. And just as we're finishing up here, I want to make a point about buying gold and price levels, right? Because we do have gold close to all-time highs right now, silver also pretty high. And I think that people look at it and they wonder, well, I've been told that I shouldn't buy when the price is high. And then they get stuck in this trap of when should I buy? What's the right time? So what would you say about that?
I would say if you don't have any gold, if you're 100% all in on the dollar, and the dollar is making new all-time, so the only way to measure the dollar, in my opinion, is gold. Invert the gold price and say, okay, the dollar is 15 milligrams-ish, which is down from 1,500 milligrams in 1913, by the way. 1,505 milligrams, I believe is the number. You're on this thing which is making new lows, and you're saying, I'm reluctant to jump off because it's at a low. Okay, maybe, but if you don't have any gold, I think everybody should have some. And it's not a price thing. It's a, protect yourself. And you missed the boat. If you bought this 20 odd years ago, you could have bought easily could have bought at $250 an ounce. And you didn't. And here you are, You can't cry over the spilled milk of the past. You can only go forward, and here's where it is now. If you don't have any, you should have some. If you're trying to buy it as a trade, yeah, there's definitely wisdom, and you don't want to buy when it's making all-time highs. But I think we're in a very funny environment, and we'll see how this banking system crisis plays out. But I've written at least a couple of articles, and I gave a talk last summer in Vienna using the German word for the position that the Fed has put itself in, Zugzwang, which is a position of no win, and it's used in chess. You have to make a move, of course, and none of the moves that you make improve your position in any effect. They will weaken your position. And so you don't want to move, but you have to, so you're in Zugzwang. They can let people take real losses, which is going to be a breakdown in a lot of things, or they can just throw everything they've said out the window and all, what their quote unquote credibility out the window, and go right back to zero interest rate policy where we were post 2008. And neither of those are attractive if you're the Fed. What they're going to do, I have no idea. I can't predict human behavior. I can say how the monetary system is working. All the forces are pulling the interest rate down. And when you see an inverted curve, that's one of the things it's saying right now. But when you look at that and you say, okay, they have no win in there, there's nothing they can do that's going to be a win. You want to hold their credit exclusively, 100%, be all in on their credit paper when they're in a no-win position, or do you want to hold some gold? And it's not that I'm saying gold's going to go up tomorrow. Maybe it does, maybe it doesn't. I like to use the example of Cyprus. And most people may remember the Cyprus banking system collapsed in, was that 2013? I don't remember what year it was. That's a while ago now. And, when the banking system collapsed, they first of all, there's a bank holiday for a few weeks. Nobody can get their money at all. And then after that, they said, okay, well, we'll let you get, it was like €100 a day. It was some tiny amount, and it was all basically locked in the banking system. So if you had bought gold the day before that happened, it wasn't that the price of gold was going to go up in euro terms. And as a matter of historical fact, it did not. The price was sideways to maybe slightly downwards. But if you had your money in the form of gold coins in your pocket, you could go to the harbor in Nicosia, get on a boat, go to mainland Europe where there were plenty of jobs, versus the island of Cyprus where the unemployment rate was 40-something% and nobody had any money. So you could sort of get out of Dodge if you had gold and go somewhere else. So gold protects you against all kinds of situations that seem increasingly likely to be, coming our way. And it's not a price thing. And now I do have a short term, we have a model that calculates, what if you back out the effects of the speculators? And the speculators can use leverage. Futures market offers about 20-to-1 leverage. FX market, I think you can get 100-to-1 leverage in some cases. So the leverage guys can move the price around, at least in the short term. And right now they're pulling the price down. They're pessimistic. So I would see relatively short term 22 to 2300 price in gold. If nothing changes and eventually the speculators stop being so pessimistic, $28 in silver, something like that. Not huge dramatic moves, but obviously it feels good if you're buying and the price goes up. But that's not really what I'm trying to say here. What I'm trying to say here is if you don't have any gold, you're 100% all in on the fast falling credit that's run by people that have gone mad. And they're cheating, and they keep breaking the rules and justifying why it's okay to break the rules. The Fed is insolvent by conventional accounting standards. So what do? They come up with new accounting rules for the Fed. The banking system is screwed, so they're coming up with new term bank loan facilities to kind of give them a bailout on the sly. And all these little cheats are going on. And everybody that owns dollars, and especially owning banking system deposits, are the rubes that they rely on to just accept it and say, thank you, sir, may I please have another?
Okay, I think that's a good place for us to wrap it up. There's so much good information in here for investors. And as I mentioned at the beginning, we will leave the link to your full report in the video description so that people could check it out if they want to. Thank you so much for coming on to talk to us about what's going on in the gold market right now. I think this was great.
Thanks, Charlotte, for having me.
Of course. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Keith Weiner with Monetary Metals.